Hello and welcome to this session on trade life cycle. In this session, you will learn about settlement methods such as gross and netting, bilateral versus multilateral, fixed date versus rolling, free of payment and delivery versus payment. Settlement of securities transaction refers to the process of exchanging securities and cash between the buyer and seller in order to discharge their respective obligation. A trade cannot be deemed to be settled until the both securities transfer and cash transfer are final and irrevocable. Nowadays, this transfer takes place electronically by book entry rather than physical movement of certificates. Settlements take place through various methods that have been created in order to minimize the risk of default. These settlement methods include gross versus netting, bilateral versus multilateral, fixed date versus rolling, free payment and delivery versus payment. Let us begin by understanding the gross type of settlements. Let's say ABC has executed two transactions with XYZ. In trade 1, ABC buys $100 million and sells 112 million euros. In trade 2, ABC sells $101 million and buys 113 million euros. In the gross settlement concept, ABC will pay 112 million euros and $101 million and expect to receive $100 million and 113 million euros. The risk here is that ABC would have made their payments, but XYZ can fail their payments, resulting in a loss to ABC. Instead, wouldn't it make sense if the counterparties, the net amount resulting in ABC paying $1 million and receiving 1 million euros? So, even if XYZ fails to receive their payments, ABC now has only lost 1 million euros. The above concept is known as netting. So, what are the key differences between gross and net settlement methods? Let's find out. Under the gross type, every transaction will have one payment and one receipt. Hence, using the example we just saw, there will be two payments and two receipts. ABC will pay $101 million and 112 million euros and receives $100 million and 113 million euros. Under the netting type, all transactions within the netting criteria will settle as one amount. There will either a debit or credit per currency, that is one payment received per currency. Using the above example, ABC will pay $1 million and receive 1 million euros. Let us now look at netting. Netting occurs when trading counterparties agree to offset their obligation and position. It is on this netted position that two trading partners settle their outstanding obligation through transfer cash or securities. Next, let us understand the importance of netting. Netting is important as it plays a role in risk factors such it reduces credit and liquidity risk. Netting aggregates or combines two or more obligations to achieve a reduced net obligation. Netting reduces credit exposure, which in turn reduces the risk of parties defaulting and reducing liquidity in market. By merging all of the transactions into single agreement covering the running accounts, the credit exposure that would be faced to a single net amount. Netting can also be reduced bilateral payment flows to net amounts and thereby reduce operational costs and liquidity needs. By reducing the reciprocal amounts to be settled on each value date for exchange traded foreign exchange. For example, bilateral netting can also be used to reduce the size of the cross-currency settlement risk which a bank incurs when it pays out fund in one currency before receiving payment in another. Next, due to netting, the central counterparty may improve the efficiencies of securities and funds transfer by reducing the number and overall value of payments between financial institutions. Netting can enhance the efficiency of national payment systems and reduce the settlement cost associated with the large and growing volume of foreign exchange transactions. Lastly, the transaction costs and bank charges involved is greatly reduced as only one payment is receipt is made per currency. Next, under the rules of netting, there are three basic rules. First, the currency should be the same. Secondly, the next settlement date should be the same. Lastly, the counterparty should be the same. Thus, under the net settlement method, ABC will pay $1 million and receive 1 million euros across the both transactions. Hence, there is one payment and one receipt in each currency. Let us now learn about the types of netting. There are two main types of netting: bilateral netting, and that is between two counterparties only, and multilateral netting, which is through a central counterparty. Bilateral netting involves numerous one-to-one transactions that appears to be independent but really are interconnected. Under bilateral netting, trades between the same two counterparties in same security are offset. There is only one cash transfer by the end of the day. Then the transfer of each security is carried out separately with an assumption that securities are of different companies. If all trades belong to the same company, then only one transfer takes place. Coming to multilateral netting, a multilaterally netted settlement refers to the case where three or more bilateral positions are netted off against one another. It ensures that default of one transaction does not cause a domino effect failure throughout the market. Multilateral netting extends the netting to cover all trades in the same security by any number of counterparties. It is generally used when there is a clearinghouse in settlement process. This will result in each counterparty making only one transfer of cash or securities to CCP. Thus, it would require central clearing system to establish the cash and securities obligation, each counterparty, and to instruct respective settlement obligations to settlement agents and central securities depository. Let us look at the example of multilateral netting. Netting the obligations for security ABC, where member 1 and 2 and member 1 and 3 novate to the central counterparty, and the end result is one contract between CCP and member 2. And another contract is between CCP and member 3. Through netting, member 1 no longer has any obligations left. With CCP playing its role, members experience a more efficient settlement process as well as less collateral and liquidity constraints. Let us take an example to compare and contrast between these two types of settlement. Considering that participants A, B, C, D have bilateral obligation with each other as shown in scenario A, if each of these positions was settled bilaterally, that is with no multilateral netting, a total of 410 of liquidity would be needed to settle all of these positions, that is 30 plus 60 plus 70 plus 70 plus 80 plus 100. In a multilaterally netted system, the final obligation owing to or by each participant is sum of the individual bilateral position, and all multilaterally netted position of obligation of all participants must be to 0. If obligation in scenario A was settled on a multilateral netted basis, the resultant multilateral settlement position would be reduced as shown as scenario B. Thus, the total value of liquidity required to settle these positions would be reduced to 210 under multilateral netting, which implies to a reduction of 200 or nearly half the amount of liquidity required. We can also classify settlement methods based on the date of settlement. These methods include fixed date settlement and rolling date settlement. Let's learn more. In fixed date settlement, trades that are executed within a specified period, also known as an account period, would settle on a specified date. It refers to a method used in exchange traded future products, that is on exchange traded derivatives. For example, if a trade is executed in month of May for a settlement in May, it will settle on the last Thursday of May. Thus, if the trades are executed on May 4th, 11th, 14th, 20th, they will all settle only on 28th May 2015. Coming to the disadvantages of fixed settlement, there can be lengthy delay between trade execution and trade settlements, dictating that sellers must not receive prompt payment for their securities, and this result in extended credit exposure to the counterparty. Furthermore, failed trades cannot be represented for settlement until the settlement date and the end of the date next account period. Hence, failed trades may remain unsettled for an extended period. It is also likely that there is a risk that the non-defaulting parties will incur a loss when replacing unsettled contracts. Moreover, a fixed date settlement creates peaks and troughs of settlement activity, which puts a strain on settlement operation at the peak times. Due to limitation of fixed date settlement that we just learnt about, rolling settlement has become quite popular. But what is rolling settlement? In a rolling settlement, the settlement occurs on a specific number of business days after the trade date, such as T+2. This limits number of outstanding trades, reduces the aggregate market exposure. Most countries have now adopted rolling settlement for stock exchanges. Under rolling settlement, if a trade is agreed on May 4th, the trade will settle on May 6th. If it is agreed on 18th, it will settle on 20th, and so on. Now let us learn about another type of settlement, which is called free of payment, or FOP in short. FOP settlement refers to separate non-simultaneous exchange of cash and securities between counterparties. Under this settlement, one or both parties in trade will be forced to deliver securities or pay cash before they have taken delivery of corresponding asset from the other counterparty. Thus usually done when the counterparties of a trade has a low credit rating or a very high credit risk. Consider an example. In bonds market, one party borrows German bonds. Here, the collateral that is posted can be French bonds or equivalent. On the end of settlement day, the party can return the German bonds and receive back French bonds. Here, there is no exchange of cash in complete transaction. Next, we will see what is delivery versus pay, which is also called DVP in short. DVP is a procedure whereby appropriate arrangements are in place to ensure that a transfer of security is final only if the corresponding transfer of funds is final. It involves simultaneous exchange of securities and cash between buyer and seller, which in real world is done by their respective custodians and settlement agent. By doing so, both parties are protected against the risk of counterparty default. In other words, if you don't pay your amount, you will not receive your expected receipt. Delivery versus payment is from the buyer's perspective. From a seller's perspective, this system is also called receive versus payment, RVP. Let us now review an example to understand how DVP helps the international settlement market. Considering that a transaction is agreed between two banks, that Bank A in London and Bank B in Zurich, where Bank B pays in US dollars and receives in Japanese yen. Since Japanese yen has to be paid first due to time zone differences, there is a risk that Bank B receives JPY but does not pay USD. This we have already seen is known as Hurst-State risk. Therefore, to prevent such scenarios, the market can use GVP method by using an institution such as continuous linked settlements to settle the trade. Here, both parties need to deliver the currencies, that is USD by Bank B or Japanese yen by Bank A. Therefore, before they can get their respective receipts, which means USD by Bank A and Japanese yen by Bank B, thereby by using delivery versus payment method, we reduce the settlement risk. With this, we come to the end of this topic. I hope this session was insightful for you. Thank you.